Hi everyone. So today's video, what I want to talk about is why the default way to put a pension, whether it's for yourself as a director or for your employees through the business, isn't the most tax efficient and what you can do about it to make it more tax efficient. The default way of getting tax relief on a pension when you put it through your business is essentially something called tax at source. And what that means is when you put it through your business, it appears in your payslip, and on your payslip, it reduces your income tax to give you tax relief on it. I'll explain why this isn't very tax efficient. You don't just pay income tax. If you're a director, you might not pay any income tax anyway, but that's a different thing. I'll explain it in a minute. But employees don't just pay income tax, they also pay national insurance as an employee, but you as their employer also pay employers' national insurance. So the problem with the default tax at source method is it gives you income tax relief, but it doesn't give you relief on employees or employers' national insurance. So you end up paying quite a large bulk of the tax on that pension without getting relief on it as a business. Obviously, as a business, if you can reduce your employer's national insurance bill, you can pay more to your employees for their pension. You can give some of that saving to them, so that's better. You don't have to, you could keep that. And as an employee, if you can reduce the 8% or 2% national insurance you pay, then that's great because that means more money in your pocket as well. So the method you want to use to actually be really optimized in terms of pension contributions is something called salary sacrifice. So what that means is instead of paying you the same amount of salary, you get paid less salary as an employee. As an employee, you pay them less salary. And then because of that, you then pay more into their pension directly. Because you paid more into their pension directly, they've already got the income tax relief because they had a lower salary, but also they didn't have to pay any employees and you didn't have to pay any employers national insurance on that lower salary. So that's how you get it. There are a few things that you have to factor in here because if you've got employees on very low salaries, for example, they can't necessarily go below a certain limit. It might not be appropriate, but if you aren't using salary sacrifice, then it's worth looking into. You might have to make some changes to your contracts, get your HR people involved, but in the long term, you can save quite a lot of money on national insurance if you go down that route.